But as central banks are strong price insensitive buyers, they'll just buy at whatever the price. The sell side of this volatility that we're currently witnessing, it really is driven by speculators who are merely racing from pillar to post. They're hopping into safe havens, better buy risk, and then sell gold and bonds, and versus the risk markets, basically, which is what we're witnessing right now. And it's this highly leveraged price sensitive speculators that drive this short-term volatility we're witnessing today. And let's start by connecting just some of these main bullet points, and that under the short-term chart chatter that we're seeing here are driving a series of higher physically supported stair steps. So Shane, let's start with with why gold continues to rally without participation from Western investors. So while Asian ETFs exploded into all-time highs in April, now April alone exceeding all of 2024 demand, when weighing up Western demand as a percentage of BRICS-centric physical demand, so one's paper, one's physical, when you weigh that up, the absence of sufficient Western speculator gold market participation continues to actually limit the scope of COMEX siloed, officially orchestrated rinses, of which we're seeing today. Now, while we've just evidenced another round of the ebbs and flows of tariff uncertainty, ultimately this lack of easily flushable COMEX-centric spec open interest, as what it is doing is setting up a perfect scenario for gold to continue to build on its globally determined, physically supported higher stair steps. Now, drilling down, while the PBOC exchanges dollars for gold at every global AM and PM fix, because that's the benchmark where you need, as an auction, you need to have an auction price when you're buying in that kind of size. And so, but they're very disciplined they also know these COMEX-centric events, such as non-farm payrolls, FOMC, options expiry events. And while they're insensitive to price, they use this paper-induced volatility to load up official monetary gold reserves without driving the price higher. In other words, they're alchemizing dollar price paper gold into fully paid for physical 400-ounce bars flowing out of London, unrecorded, and that doesn't require reporting requirements, and a lot of it doesn't appear even in the customs data. We went through how there are something like 40-something custom brokers exchanges, and this shuffling gets deliberately lost. Also, when the generals buy, and generals control a very large amount of gold, official gold reserves, none of that is reported. That is military, that is what you would call secret. So a quick look at the charts is probably the best way to illustrate this, but liquidity providers reported very large PBOC buying and insurance-related spot gold demand had accrued at spot 3,300. And these very large orders got filled in large size into the Sunday spec-driven sell-off. But we've just evidenced even larger orders than that getting filled into the PM fix today. With spec long ignition largely used up, it's required naked short momentum short selling to provide the short cover for commercials exposed to an upcoming growing wall of T+1 delivery obligations to actually hedge into. Now, net of this past weekend's extreme tariff-driven volatility, it's also not going unnoticed that directly following the one-day Chinese May the 1st holiday, which is when we saw this dip here, we immediately reinstigated the Asia buys physical West sells paper gold action, and that was back on the front burner. However, given the West selling is heavily leveraged versus Asian exchanges, actually actively arbitraging the synthetic EFP spread, liquidity providers assess that spot 3,200 is where bullion banks exposed to delivery obligations will be long against the momentum short sellers, and today's fix that came in just below that really is where that filling, where those orders started to get filled, and will have driven the next waiting layer of PBOC and institutional buying. Using silver as an example, it's pretty clear that short-term speculator-driven inverse correlation has developed between the risk markets here and gold and silver. But global liquidity providers report a higher physically supported stair step is being established and is just being established today. And because central banks fill only at the fixes, bear in mind you need an auction to fill large size, so that will have actually been settled today and will require those positions to be delivered. And today marked the first gold fix sub 3,200 since the 10th of April. And the filling of these central bank bullion bids will be short-lived. The lows will be short-lived.
Let's begin at ground zero. Volatility. What you're seeing in gold and silver markets isn't drama, it's strategy. It's paper game speculation at its most frenetic. That run-up, that dump, that pop, it's not natural market behavior. It's leveraged speculators, jumping from one pillar to the next, trying to stay ahead of the narrative so they don't get squeezed. Look, what fuels this is capital sensitivity. Speculators chasing headline-driven momentum, only to get burned when the party ends. They hop into risk-on, then scramble into safe assets, fueling knee-jerk moves. And boom, one day gold's soaring, next day gold's crashing. All while central banks quietly accumulate at the auction fixes. Let's connect a few critical dots here. First, Asian ETF demand in April exploded, surpassing all of 2024. While Western speculators stay on the sidelines, Wall Street remains engaged in paper-driven slogs. It creates perfect blind spots. We get these COMEX-engineered price moves, but the price is managing perception, buy the dip, sell the rally, while physically backed stair-step accumulation continues. They're buying gold at every global AM/PM fix because that's where you get liquidity for large-scale bullion orders. And note, Lincoln-esque discipline. They don't chase, they don't trade. They buy when the paper volatility triggers dumps, letting fundamentals accumulate bricks and bars without spiking the price. They're literally alchemizing dollar-price paper gold into fully paid, vaulted 400-ounce London bars. Bars that leave London unreported, and that's the silent movement Western markets aren't seeing. Look at it this way. Whether picked up in custom sheets or in anecdotal vault counts, it doesn't matter. For buyers like sovereigns and Asia's war chests, the reported price means nothing. They pay for the fix, fill the bar, walk it off, and because it happens quietly, Western traders never notice the supply drain. It's the perfect play. Use paper volatility to mask physical accumulation. Meanwhile, when risk sentiment shifts, speculators dump positions. Gold goes down. Western viewers buy Bitcoin instead, thinking that's the hedge, while Asia scoops up the metal for delivery. We've seen it again and again, and the pattern holds. Take the recent tariff scare. Paper markets tanked. Then post-May Day holiday in China, we saw a familiar pattern. Asia rebought gold aggressively, fueling physical demand, while Western hoopla pounded paper prices lower. It's alchemy. They're converting paper dumps into real pieces of gold by buying at auction when the fix resets and delivery clock ticks near. This isn't chaos, it's precision, a global divergence between paper and physical. Then look at the most recent fix, just under $3,200. That's not random. That's banks filling delivery obligations triggered by the fix. That's new deliveries shifting the price floor. Once that finishes, expect a rebound to new levels, because central banks won't wait. They fill at the auction and step aside. And the catalyst? It's not retail traders or hedge funds. It's institutional armies. The PBOC via Shanghai, Singapore's exchange, the India Mint, unknown sovereign entities buying off radar, unrecorded but real. They're building state-level strategic stockpiles of real money while the COMEX is busy printing paper and trying to drum up liquidity. That's why you see the inverse relationship. When equity markets go haywire, you see gold choppy, not rallying. The speculators short gold expecting safe haven flow, but the real buyers aren't speculators. They're policy buyers. They don't chase, they create the run-through accumulation from weakness. This is why volatility is falling out. The structurally dominant buyers, central banks, are building a stair-step base. You don't see it reflected in the price chart because paper sellers forcibly hold it down. That's not a market drop. It's a strategic accumulation window. Ask yourself, when was the last time gold spiked on an FOMC report or NFP print? Yet that's exactly when Asia buys the most. They let COMEX dump the price, gather at the fix, and take delivery. It's like they're playing a blindfolded chess match, and we're making rookie moves, just reacting. Now, before you say, Andrew, isn't that conspiracy theory? I only play with facts. I talk to vault operators, liquidity providers, custodians. I hear stories about massive physical fills into the PM fix. I hear about oversized orders being executed into the US morning fix, but without price spikes because banks and sovereigns catch that waterfall. The pattern is crystal clear. Downward paper moves trigger physical buying at the pivot point, then accumulation continues until delivery obligations reset. Then the game starts over, with banks having offloaded risk and governments having taken on the metal. It's not the COMEX setting prices anymore. It's the physical fix determined by buyers too big to care. The WSJ and CNBC won't report this, and by then, the next liquidity event is underway. But as contrarian money says, buy the rumors, ignore the headlines, follow the vaults.
This leads us nicely into the second bullet point, which is COMEX is becoming a price taker. You'll look at the chart and you'll go, we're going down. Don't be fooled by today's short-term chart chatter. That's all it is. This is the last kick at the can ahead of Basel III US compliance at the end of this quarter. Now, Western gold investments are largely represented by highly leveraged COMEX futures-driven speculators seeking to track the price of gold. And to do so, they just have to invest really 4%. And this is a derivative position, which is where you just have 4% of skin in the game. And these are cash-settled investments. They're never designed to be delivered. And they're borrowed from the house market makers. Well, do you figure that's any dissimilar to the synthetically structured world of a casino? I mean, the market makers, the pit managers, loan out this fractionally backed gold, silver, open interest, the chips, as we've said, while taking the other side of these bullish or bearish speculator bets. If they're betting against the house, then the house is on one side. If they're betting with against the house, whatever it is, the house is on the other side. Now, these chips, though, think about it. These chips are not exchangeable outside of the casino. So this is why we called it a siloed market, because everything that you're shuttered in, there is no windows. This is why it's so similar to a casino environment. Historically, this highly leveraged gold derivative structure that could be profitably managed in-house and return a standard 95% win for the house and just enough of a 5% win to keep the speculators trying their luck against the house. Now, this is what led the last 50 years of the gold derivative tail wagging the physical dog price. However, as we've been tracking following the BIS, the Bank of International Settlements, reclassifying physical gold as a first-tier asset class, the global gold price is increasingly being determined by competing BRICS-facing physical exchanges. Now, all the BRICS exchanges require that a gold bar has to be bought, titled to the buyer, and then fully paid for clearly before you can ever offer that for sale. And this is how a real supply-demand globally fungible gold kilobar price is determined by somebody who really is willing to sell it for a price or buy it for a price. There's a balance there. Now, physical market liquidity actually has now migrated to Chinese-anchored BRICS-facing exchange. China anchors these exchanges. China has now become the physical dog wagging the COMEX tail, regularly alchemizing the globally underpriced synthetic price, utilizing the backdoor exchange for physical conduit. We talked about it multiple times. It is the way of getting, it's the Achilles heel, it's the back door of the COMEX where you can actually convert an otherwise undeliverable cash-settled COMEX price with only a 4% investment in it into a 100% paid for, physically settled T+1, meaning 1-day delivery, NSFR compliant physical bar. Now, as we looked at really most recently, I think at last time, a rash of recent calls from technical traders. They're currently calling for the synthetic gold tail to keep wagging the physical dog, and they're having some success today. What they're doing is chasing moving averages, hunting out, are there any longs or shorts that they can garner at these? This is the house at play. Now,
let's pick up where we left off. The auction fix. The battlefield where the real war over gold price is fought. Now here's the thing nobody in the West is talking about. These massive bids we're seeing into the AM and PM London fixes, especially after these orchestrated dumps, are not coming from hedge funds. They're not coming from Reddit. They're coming from governments and their proxies, filling orders quietly, in size and off record when they can get it. And the Western paper speculators? They're not even in the room. They're too busy chasing short-term trend lines and options gamma squeezes to see the forest through the trees. Let me say it again. $3,200 is not expensive to someone exchanging worthless dollars for real monetary reserves. That's the play. That's why every time we dip below $3,200, it's temporary. The fix comes in, the orders fill, the bar flows out of London, and we go right back to $3,250. Sometimes within hours. This is what a central bank-driven market looks like. Controlled, calculated, price insensitive. You might not see it if you're watching the 5-minute candles, but take a step back and look at the higher lows, the tightening wedge, the massive premiums in Asia. That's where the real signal lives. Let's go deeper. The reason gold isn't collapsing under this selling pressure is because these sellers aren't selling anything real. They're selling unallocated synthetic positions, borrowed ounces, over-the-counter exposure, 4% margin casino chips. That's the COMEX model. But here's the catch. The open interest on COMEX has been steadily declining. Every time the big players short the market, fewer and fewer contracts are out there to absorb that pressure. The house is losing control of the game because the physical market is draining the chips off the table. Even the exchange for physical EFP mechanism, once a safety valve that allowed market makers to shuttle risk into London, is now turning against them. Physical demand in London is too strong. Vaults are thin. Liquidity is drying up. There's nowhere to hide. We've seen deliveries spike, even in months where open interest suggested minimal physical interest. That tells you one thing. Real players are standing for delivery unexpectedly, breaking the model. Let me share something else. According to my sources in liquidity provision, spot buyers are filling orders north of $3,300, especially during US-induced sell-offs like we saw after the recent tariff announcements. But what happens? Gold dips, the order book absorbs the sell-off, and the stair-step structure builds again. You don't get that in manipulated one-sided markets. That's a sign of a broken pricing mechanism, one that can no longer hold the illusion of control. And silver? Oh, silver is the fuse. Why? Because while gold is being slowly repriced via these high-level stealth purchases, silver is under industrial and monetary pressure simultaneously. It's the kill switch. It's rehypothecated to a far greater extent. It's thinner, it's cheaper, and when it breaks out, it breaks violently. You've got central banks offloading silver exposure to non-bank entities. You've got China buying doré and concentrate in South America, refining it quietly and keeping it off the grid. You've got India importing nearly 1 billion ounces in 5 years, and those are just the visible numbers. And all the while, what's happening on the LBMA? Rehypothecation. Traders are moving 10 times the actual float. One of the largest bullion banks admitted that the daily settlement volume exceeds global annual mine production by a factor of 3. You can't have that kind of leverage without eventually breaking the mechanism. And here's where things get really interesting. There's a theory emerging, and I want to be clear, it's just a theory, that elements inside the US banking system are using this silver accumulation as a geopolitical lever. That by draining silver from London, from Bank of England-linked vaults, mind you, They're putting stress on the European monetary system. Could it be part of a broader strategic retaliation? Maybe. But even if you strip out the theory, the data's loud. The COMEX and LBMA are bleeding real ounces. That doesn't happen unless someone is calling in physical at a rate the system can't cover. And that's why I keep saying, watch the T+1 delivery obligations. They're the cracks in the dam. As soon as you can't meet one of those contracts, just one, the entire narrative around price discovery collapses. Because price discovery only works if you can actually deliver the thing being priced. Let's talk numbers. Just this month, over 13,500 contracts of silver stood for delivery. A record. That's nearly 2,000 tons of silver. A good chunk of that was transferred from banks to non-bank entities, meaning institutional buyers are demanding metal outside the banking system. Why? Because they don't trust the system anymore. And neither should you. When the LBMA says they're expanding delivery windows from 1 day to 8 weeks, it's not because of a truck shortage. It's because they're cornered. The metal isn't where the claims say it is. They can't meet redemptions quickly enough. So they're buying time. Literally. This is the quiet run on the system. It's not headlines. It's not visible. But it's happening. And if you wait for Bloomberg or CNBC to tell you it's time to buy, it'll be too late. Because when that T+1 fails, the price won't inch higher. It'll gap. Silver will leap from $32 to $55 to $85 in days, not weeks. Dealers will shut down online sales. Mints will halt allocation. And you'll wish you bought at $33. And gold? When gold finally breaks free of this synthetic yoke, when the BRICS launch their gold settlement mechanism, when Basel III rules fully neuter unallocated paper, you're going to see a reprice event unlike anything in modern financial history. Forget $3,200. You're going to see $5,000, then $7,000, maybe even $10,000. But you won't be able to buy it because physical won't be available. Or it'll trade at massive premiums like it did in 2020, only worse. The price you see won't be the price you pay, assuming you can find any at all. So what do? You position early. You hold real metal. You ignore the noise. And you remember this. The paper market is the illusion. Physical is the truth. We are witnessing the end of COMEX price discovery. Not because someone told us, but because the vaults are speaking louder than the charts. The stair-step structure being built right now will be looked back on as the foundation of the repricing event. Get on the right side of it before it lifts off without you.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.